People have asked me often about how long do you think that this mortgage slump will continue, and I have to say that it depends where you live. Some areas of the country are going to continue for some time, and others really haven't had the slump that most of you have been hearing about. I mean, I'm saying that it's soft, but it doesn't mean that it's gone down in value. I'll give you an instance. In California right now, they still have a substantial amount of product to go through. One of the problems have been the subprime, which has hit. But the other problem that they haven't really gone through is what's called the pay option arms. And that's where you had 4 payment options. The lowest one being just an artificially low rate of about 1%. Sometimes the lowest 0.99 to as high as 2.99. Then you have a 15 and a 30-year fixed rate option and an interest-only option. Well, obviously people only pay the minimum payment. So when that occurs, the balance on that payment, so if they have a 7% interest rate and they're paying 1%, adds 6% to your mortgage each time. Well, those loans have been made primarily to people with decent credit. And what that has not really hit the market yet, the losses, because they can continue to do that for up to 5 years. And after 5 years, they're going to be about 30 to 40% underwater if it would just flat. And since Los Angeles and most of California has gone down 20-25% in value, they're looking at maybe a 50% mortgage above the value of the properties. And those foreclosures haven't hit because those are going to come back to bite everybody too. That's still probably about a year or two away. It's very prevalent in California and also in the Florida area. So those areas are still going to have some softening to do. Now, in the middle part of the country, especially in Texas, you're going to find that the values have gone down very slightly, if any. And most of the Midwest, it's been pretty reasonable. Now, there are some options that are different, and Michigan has been just devastated by lack of jobs, and their values have been really devastated. I saw one bulk package sold for a real estate professionals in Detroit, in the inner city of Detroit, for 14% of its current value. So if you had a house that they say is currently worth $100,000, it only sold for $14,000. Now, obviously, those bulk packages were in the hundreds of millions of dollars, but the fact is, it's still real soft there. In California, they're still selling packages in the, believe it or not, in large volumes, $1 billion groups or more, in the 30s, and that's pretty cheap of current value. In Texas, it's going a little bit higher. But the good news is that the investors who have the money are coming in there, and I'm seeing no more softening in those values. They're actually seeing some of the product going up for a little bit higher price. So I believe there's enough money coming into the markets to stabilize those. However, with the continuation, especially in California and Florida, of a lot of this product to still sell, there's still going to be some softening for some period of time. Another potential lengthening in that time of the slump will be the U.S. dollar. People don't realize that since 1946, a bunch of countries got together in a convention and actually made the dollar the world currency. Today, that's not the case. More people are holding the euro in reserves as of last year than the U.S. dollar. And because of that, some of the bigger countries that hold reserves, China, Japan, the Middle East, are now starting to lessen their reserves of dollars in favor of the euro. Now, you might say, how does that help the assets in the United States? Well, obviously, if the assets in the United States are of less value, the dollar is of less value, which you're seeing with inflation. That's why oil is one of the reasons it's gone up so much. But you're also going to see that in interest rates. The Fed, in the middle, long term, they're in a crisis now to protect the mortgage people. But as soon as that crisis looks like it can be abated, they're going to start raising interest rates to protect the dollar and try to get the dollar back on the good side. And the only way to do that is to significantly increase rates above the inflation rate, and it'll also stabilize it. But you could look at double-digit rates again, probably in a few years off in mortgages. So anytime you get a mortgage or home loan now, try to get a fixed rate, because I think we got a problem that's going to be systemic for some time in the future. And that also can help, in some cases, the mortgage market, because hard assets will become of more value. But it also, in the short run, could make it a little softer in areas as the rates go up.